And here's our call of the day, and it is a big call on Bank of America by longtime banking analyst Mike Mayo over at Wells Fargo. Mike, let's bring you in here. Good to see you as always. Looking at your note right now, you say Bank of America is your number one pick. Make your case.
Well, look, you're looking at the banking industry. You're about to see what we think will be the best growth in Main Street banking since the 1980s. And Bank of America is the best play on that. Now, there's almost no professional money manager who was in place in the 1980s during this last time when you saw traditional banking revenues grow the way we expect them to grow over the next 3 years. I mean, think back to the 1980s. You had Madonna, Michael Jackson, MTV, you had Ronald Reagan, yuppies, you had long hair, you had neon everything, and you had some amazing growth in what's called net interest income, traditional banking revenues. And now over the next 3 years, we think Bank of America and the industry as a whole will have the best growth in that category in over 3 decades. And that's super powerful. And it's even more in place after the news from the Fed yesterday when they announced they're going from 6 rate hikes through the end of next year up to 11. And the greatest big bank beneficiary among our universe is Bank of America. So we think the top line will be better than expected. And part of that is Bank of America getting rewarded for growing deposits over the past couple of years equal to the 6th largest bank. So they gathered all these deposits and now they get to put that money to work. So they front loaded the expenses, the revenues are back at it. But it's not just that cyclical tailwind, it's also the tech revolution at banks. And Bank of America is one of the greatest fintech players on the globe. And what we think will happen is that these new revenues, more of that will fall to the bottom line due to the benefits of technology. So you have the cyclical factors of more Fed rate hikes at a time of loans growing, helping what's called net interest income. At the same time, the tech revolution at banks allows more of those revenues to fall to the bottom line. So the business model that Bank of America has put in place over the last decade now bears more fruit than you've seen for really any period, we think, under Brian Moynihan.
Hey, Mike, it's Julie here. I feel like we need like the Wayne's World style for your flashback there to the 80s at the top. To me, when you look at the broad economic backdrop, particularly for consumers, I wonder how much of a fly in the ointment that's going to be for your thesis here. I mean, we just saw today Freddie Mac saying that mortgage rates are now the highest that they've been going back to 2019. Now, that's good to your point about the interest margin for the banks, but what about for demand? What about the health of the consumer going into this period?
Well, that's a great question. I will say the big word that's coming up today is the R word, and that's recession. And as you know, a lot of times when the Fed is done with their rate hiking cycle, you're either in a recession or close to one. And that brings up concerns about banks and credit quality. As it relates to our number one pick, Bank of America, their subprime loans have gone from 20 to 25% to the single digits. All right, so it's night and day over the last 10 to 15 years. And by the way, of the subprime loans they have, most of those customers have many relationships. So these aren't fly-by-night customers that came by. So, and the other point about Bank of America, the Fed stress test has Bank of America with the lowest level of loan losses of any large bank in a recession type scenario. But having said that, yeah, higher interest rates can reduce demand. It can increase loan losses, and that's something to be watched. But I will say, I think it's more important to watch for the non-banks, the new entrants that don't have as much experience through different interest rate and credit cycles.
So let's pick up on that for just a sec, Mike, because I'm curious about that. So then in a recession scenario, or even in a sharply slowing scenario, who in the financial universe is most at risk?
Well, I would say as a category, I think a lot of the non-bank competitors have pushed the limits far past where banks would go. So on the consumer side, you have a lot more of the, as a percentage, subprime loans being made outside the banking industry. When it comes to the wholesale side, leverage loans, you look at leverage ratios, pushing the limits are the non-banks. And one reason is due to regulatory asymmetry. So banks are required to stop and have certain prudent credit guidelines, whereas a lot of the non-banks are not required to do so. So as it relates to my coverage universe, what I need to pay attention to and bank investors need to pay attention to is bank lending to some of these non-bank entities that eventually lend to consumers or the more risky companies. But right now, I think credit quality looks very strong. It's well below average. We do have credit losses going up back to normal over the next 2 years. And remember, these higher interest rates still come from a very low level. So from a multi-decade perspective, this doesn't seem life-threatening or critical or any reason for us to lower numbers. In fact, we increased our estimates just today on Bank of America. We were already high on the street. Now we're even higher, and we're quite confident. And we are not even factoring the full benefit of all these Fed rate hikes.
Mike, let me take a little turn here because I know you closely follow JP Morgan and have for some time. One theme throughout our show today has been the retiring big name CEO, in large part because of lifestyle changes during the pandemic, burnout, whatever it is. How much longer do you think Jamie Dimon has atop JP Morgan?
Well, look, Jamie Dimon is perhaps the most successful large bank CEO of our generation. Having said that, after recommending the stock and effectively Jamie Dimon for 7 years, we lowered our rating in January. The stock well outperformed the other banks in the S&P 500 over that time. We think they're now spending perhaps too much, or at least they have to give us more reason why they're spending that much. So whether you're Jamie Dimon or any other CEO, you need to earn the right to remain CEO every day. I think it's his intention to remain on for another 5 years. The board has approved that. So as long as they deliver, then I'd say another 5 years. But if they don't deliver, especially with this record increase in spending, then I think he or any CEO could be at risk. And by the way, that's a big difference versus Bank of America. JP Morgan is effectively, not intentionally, but effectively spending the benefits of the rate windfall to spend a lot more in technology, whereas Bank of America is not. Bank of America has invested consistently over the last decade. They've gained share in digital banking, online banking, their chatbot. They've gained deposit share. So it's working. They don't need to see a need to do an abrupt change with their spending, and that's in contrast to JP Morgan, which may or may not work, but we're getting on the sidelines on JP Morgan while they do this, or at least why they try to explain why they're doing this, whereas Bank of America, it's steady as she goes.
Well, Mike, and I think I remember you talking about this, maybe it was the last JP Morgan call, that pickup in costs, like you mentioned, and that did hit the stock. I mean, to that end, do you think it's time for fresh eyes at JP Morgan?
No, I think it's time that the newly placed people at JP Morgan, they have a new CFO, they have new CFOs of 3 of their 4 major business lines. They have a lot of new people in new positions. I think it's time that these people stand up more forcefully to Jamie Dimon and say, hey, you should do this, you shouldn't do this. It's hard to stand up to Jamie Dimon. You better have your facts straight. You better have done your homework. And I think it's a little bit of newness with the current management team. And I think historically, Jamie Dimon has helped his team find their way, but they lost it for sure on that year-end 2021 earnings call in January. That was probably the second worst earnings call of Jamie Dimon's career, second only to the situation with the London Whale earlier last decade. But to their credit, my concern and the collective investor concern was they're not giving us enough detail about where they're spending all that money, and they're not giving us metrics. They're not even having an investor day. But now JP Morgan is going to have an investor day, and my sense is they're going to give more information to investors. And so, what Jamie Dimon has done great, better than perhaps anybody else, is when they're going in the wrong direction, he cuts losses, he helps the firm reverse course, and it looks like they're trying to do that, at least with the transparency as to why they're spending that much money. It may or may not, ease our concerns, but at least they're correcting course.
Wells Fargo Senior Analyst Mike Mayo bringing the fire with his call today. That call today is Bank of America, which is his #1 pick.